Welcome to the AJ Brown Show, where we talk about all things investing, options trading, and the like. Now, here's your host, AJ, whose primary mission in life is to help you become a better investor.
Good morning, ladies and gentlemen, and welcome back to another episode of the AJ Brown Show. My name is Cyprian Francis, and with me, as always, the main man of the hour, AJ Brown. Good morning, AJ.
Hey, Cyprian, how are you doing? I'm getting my voice back slow but sure.
That's right. I was just listening to the intro Christmas music, and I wanted to just throw out there, it's beginning to look a lot like Christmas, right? And,
Holiday
season, and historically things tend to slow down, but we're getting a lot of information. We're getting a lot of movements in the markets, and we just had our repeat show or our makeup show on Tuesday, and we were talking about the big Fed meeting, and we guessed correctly, but the market didn't like the news. So I figured we should start with what happened with the Fed, and what are you seeing on your end?
Well, it's a combination of the Fed meeting. So the Fed meeting minutes came in exactly like we said they would, which was a 0.5-point rate hike. But it's what they said during the press conference. So they have these meetings throughout the year, but 4 times a year, the Fed chairman, in this case, Jerome Powell, gets in front of reporters, and it's called the Fed Chair Press Conference. And he says his words. Sometimes they take questions, sometimes they don't. Anyway, his words left investors kind of questioning, to say it nicely, a little bit depressed. Basically, he said, hey, we're seeing some results, but the results are nowhere near where we want them to be. And so we're going to keep marching on. There's no end in sight. And so investors kind of didn't like that at first. And then, of course, they came back on Thursday, and combined with this retail sales report. Take a look at this report that came out. You know, the holiday season, a lot of stores, retail stores, make no money throughout the year. They're always running in the red. And it's thanks to the holiday season that they finally shore up their books and make money for the year. Well, retail sales, as you can see here, they were hoping for just a small drop. They got a really big drop. And when you factor out the very volatile vehicles, they were hoping for a slight gain. They got a drop. And they were hoping for an even, a tepid when you factor out the price of gas. They knew gas was going to go down in price. Well, another drop. So retail sales disappointed. And on top of that, the Fed saying that they're not stopping anytime soon. Well, this is where I have to admit I got one little piece wrong. If you remember, Sip, I was saying that we would have a pullback to halfway, and let me get my marker out. We would have a pullback in the S&P 500 to about halfway of the previous retracement, and we did. And I was actually thinking that the Wall Street would be okay with what the Fed said and would give us one more expansion move and give us one more push in the bullish upward direction. And this is where I was wrong. Now, I did say that come January, we would start seeing some pullback again in the medium to long term, because that's exactly what the Fed was telling us before. In fact, their message really hasn't changed. I think people are just like really optimistic and hoping for the positive. And when they get told over and over, there's nothing positive about to happen, well, they finally take it to heart. And so instead of getting an expansion move is whenever you get greater than the previous move, we got another contraction move. In fact, this contraction move, if I measure it with my little ruler here, there we go. If we measure it with my little ruler here, this was comparing it to the previous move, this was a move right to that halfway mark. So this is a telltale sign of a reversal back down. Now, it needs to mature to be a downtrend, but this next move that's already in play based on yesterday's trading and now look at what's happening today, already has this next expansion move meeting our criteria for being in a downtrend. So it almost looks like, and we can trace it back to December 7th. It almost looks like we've had as of December 7th, a move back down south. One more move up that only goes halfway the previous move, and we'll call that a mature downtrend, and we'll for sure be saying the bear has jumped out the window. So the piece I was wrong on is I said this would happen in January. It's happening right now.
Well, I think it's that spending, right? No, I don't think people expected the spending to curtail so far back, given like right now we're the last 2 weeks of the year. I mean, people are spending more than they normally do. So I think that was the shocking point there. And another thing that we tend to look at, right, when this information comes out, is what is the Fed doing with the bonds, right? And so the meeting came out, the rate was only increased by 50 basis points, but they're doing the same thing they've been doing with the bonds, right? Like that hasn't lost any steam, has it?
I have to say that this whole bond buying and selling is so experimental. I keep saying that because the Fed's been playing with interest rates since the beginning of the Fed, like in the 1950s. The Fed's been controlling the economy, but this bond thing, they really haven't gone into buying bonds and selling bonds in mass since about 2008. So this is a very new tool, and I don't even think they understand how it works. But yeah, they're on this selling spree. In fact, as of the end of last Thursday, they were down to 8.582 trillion. That's from a high of something like almost 9 trillion. So they're $500 billion of bonds they've sold back to the market. In fact, if we take a look at just what they reported yesterday, it takes them a while to add it to that graph. They went down another 50 billion. So their target is actually to sell almost 100 billion, 95 billion every week. But right now they're at about a 40 to 50 billion sell rate. And I'll tell you, it's having all these crazy effects, right? One of the effects that I've been noticing is by them selling these bonds, right? They're making bond prices, or the yields, not prices, but the yields that these bonds return go way high. And so what that's actually done is it's drawn investor money, because investors are like, wow, all of a sudden these bonds are paying better than the S&P 500. They're paying 6, 7, even 8 or 9%. We're going to start investing in these bonds. And so there's a lot of investor money moving from whatever investments they were in prior to these bonds. And what that's done is it's actually, because now all this investor money is going at it, it's causing the bond yields to go back down because you have more buyers than sellers. The biggest seller of bonds has been the federal government, the Federal Reserve. And so they were thinking, well, bonds will go up. Well, all these investors like those high returns. And so they're moving all their money to these bonds. They've caused bonds to actually go down a little lower than what they were. And so we're seeing mortgage rates. They were topping out at like six and change. They're now, coming back down to the low sixes, even high fives. And I have to say that this is a temporary situation, of course, because the other thing that this is doing is when the Fed sells these bonds and they make some money off of selling those bonds, they take that money and they basically shred it. So they're making less money out in circulation. And so that's going to drop prices, right? Because when there's less money to go around, money is worth more. And so things that cost maybe $120, those dollars are now going to be worth more. But it doesn't seem like that. And it's playing with people's minds because they're like, oh my gosh, this thing that I just bought for $120 is now only worth $100. It's lost $20 in value. They're not taking into consideration that the dollar is now worth more because they're dealing in their local economies, and the dollar being worth more is only good if you're buying stuff abroad, right? So it's quite confusing, but people are feeling like they're getting the shaft.
Yeah, and I think the best way to actually measure that is another statistic that we like to look at, and that's the income outlays and savings rate, right? And so, are we still seeing that same trend that we've been eyeing the past couple of weeks?
Yeah. So here's incomes, right? That's great. And when you look at expenses, well, that's also going up, as you can see here. And when I put them right next to each other, what you might notice if you look really carefully at this chart, and let me kind of get here, is that the expenses are going up faster than the income. The income is kind of going at a slower rate. And so what does that mean? It means that people are dipping into their personal savings to keep that same spending rate. And so people's personal savings also is disappearing. And so there's going to be a point, and I don't forecast it to go very far in 2023, where people are going to not want to lose all their savings. I mean, credit card debt is going up right now at an alarming rate. Savings is going down. There's going to be a point where people are like, enough is enough. I'm going to tighten my belt. I'm going to not dip into my savings to maintain the lifestyle I am. And it's going to hit like a ton of bricks. And so, a lot of people have this rosy outlook. They just want things to be better. I fear that we're going to hit a wall in 2023. Things are going to come to a stop, and it's going to be more about, can we get this thing rolling again?
Yeah, and that's really one of the basis of the show, and why you created Trading Trainer is because we can expect these things to happen, but a way that we can deal with the effects is by investing wisely, right? The one of the most powerful things about options is that when we see things turning to the downside, we can use this tool to invest and make money so that we're not affected like everybody else.
Yeah. You remember that movie that came out about 10 years ago with Brad Pitt and Christian Slater and Steve Carell? I think it was called The Big
Short.
The Big Short. And Christian Slater was the guy who was shorting, and investors were losing doubts in him, but he had the tools. He knew the tools. And guess what? When the market collapsed, he made a fortune, right? And so did some of the other investors that saw what he was doing and started to do the same thing. And so we have the tools as investors. So no matter how bleak it looks, you have to remember that the markets are not a place where money gets destroyed or created. The markets are where money changes hands. And so you just have to be able to identify what the heck is happening and be on the correct side of the equation. Options are a perfect vehicle to do that. So yeah, as investors, we just need to know what we're doing and we'll be fine. In fact, I've been fine through all these downturns, whether it was the dot-com bust, whether it was the gas bust, the energy bust in the end of the 2000 aughts, whether it was the Great Recession. I always seem to do well. So I think if people follow along with some of our strategies, they will too.
Yeah, and if someone wants to follow along with those strategies, doesn't know where to begin, we've got an awesome webinar that AJ puts on. The link is in the chat. Basically, it's going to walk you through how to utilize options to create an income stream that almost feels like a paycheck. I mean, I think that's what everyone would want in a downturn. So go ahead and check that link in the chat if you haven't already checked it out. If you have any tickers that you want AJ to go over, we're going to go ahead and do that later on in the segment. We're going to take a break right now, and we're going to come back and talk about some names that Wall Street has given up on. I'm curious to see what's on this list. So we'll be right back, everybody.
I get it. You're afraid of trading in the markets. guess what? I've got your answer. I've got 4 strategies I'm going to give you along with the tools to make it super easy. I'm going right home, giving you the webinar. I need you to sign up below and meet me in a few minutes.
Yeah, so when I saw this question come up in our topics section, I was curious, seeing as you've seen some downturns in history. I mean, not that far back, but you've seen the downturns. When you look at these like Wall Street darling names, when the economy starts to hurt, do they tend to hurt as well? And like, what's the relationship there?
Well, yeah. I mean, we just got through pointing out that this dynamic that the Fed is creating with their bond selling thing is causing investors to go for these sure deals. Bonds are sure deals, right? If you can lock in a rate for the next 10 years of 7%, that's a sure deal. So money is flowing out of all these other areas that was very popular, just like not even 18 months ago, 2 years, 3 years ago, all these areas. And so there's a lot of simple names where all of a sudden Wall Street investors are like, this is too risky of a play. I'm putting my money in safer investments. And so some of the names are ones we've featured on this show in the past. So how about Rivian? Rivian is the electric truck maker. So
they were supposed to be the next Tesla, right?
Yes, that's absolutely right. And so you can see this is this goes back to when Rivian went public. So we're talking about going back to 2020, 2021. Sorry about that. And so Wall Street's pretty much said Rivian's not viable. You can tell just by looking at the chart. And so you got to think about the situation, right? Ford F-150 Lightning. General Motors just said that they're coming out with a whole Chevy line of electric trucks. The Hummer is out already. You've got Cadillac coming out. You've got the Cybertruck. So Tesla has been in the name, and Tesla was very creative at making sure their name was known. So Tesla has established themselves, but now you've got these huge car companies that are going EV, and these little guys who couldn't get their act together fast enough, fast to market. You know, Rivian, I know, has something like 100,000 people who have already said they want a reservation on a truck. They've only delivered 6,000 of them. And these other ones, the reservations are available for people to cancel. People are going to put their eyes on that F-150 Lightning, and Rivian's, Wall Street said no. And you can see even in the last month, Wall Street saying that we're done.
Yeah, another name that's similar to that is Lucid, right? They're an electric car manufacturer.
So Lucid even just got, some sort of special battery under there. So they've got the technology, but Wall Street says we're pulling your investment. I mean, when Lucid was at its high, it was trading at $55 a share. It's down at $7 a share. Wall Street's pulling their money from their plug. And, these companies went public, going back to the whole dynamic. I know, all these ETFs, and it gets kind of confusing, but when it comes down to it, companies go public to get investor money to build out their companies, right? And so when investors pull their dollars, they can't do their job of building out their companies. It's pretty much Wall Street said, they can pull some sort of Hail Mary play, but as far as it looks like, these guys are done.
And then the big headline names, AMC, GameStop, right? Are they still
so Wall Street? Wall Street, if you remember, had already put the axe in these guys, and it was a bunch of investors who got together on Reddit. Social media is amazing at getting people who would otherwise not run into each other to connect with each other. And so a whole bunch of independent investors got together and became what I call a market mover. Usually market movers are people who run funds like pension funds and hedge funds and big fund mutual funds, right? These guys are the ones who can move the market. But these guys got together and created a tribe online, and they were able to move the markets. But Wall Street is saying, let's put the nail into these companies. Here's AMC, and here's GameStop. And so you can see these companies are coming back down. GameStop a little bit slower, but the scoop is even the small investors that were getting together on Reddit, because there was a lot of money flowing. The Fed had created a lot of money and put it into people's pockets through federal, by the Fed monetary policy that was created by giving people checks during the pandemic. That money was created there. That money's going away. And so now even the people on Reddit are like, let's put our money into these safe bonds. So they're not even able to balance out kind of the negative response from Wall Street. The biggest losers are some of these companies that really had some Hail Mary plays. One of them is Peloton, PTON. Take a look at Peloton. Oops, I typed in the wrong ticker. PTON. So at its heyday, I mean, when it went public, it was trading around $30. And then at its heyday during the pandemic, where, that was the mistake. It was like, oh, from now on, people are going to be sick at home for the rest of our lives. They made all these decisions and they were up at $170. They're down at $10 a share. Wall Street's like, unless you figure something out, you guys are done. And can't keep the doors open.
Yeah, and it makes sense, right? If pocketbooks are tightening, investors are going to be looking for companies that actually have cash flow, have some profit margins.
That's absolutely right. In fact, here's the last one I wanted to feature, and this is one that you and I have been talking about that people haven't really been, like investors I know, haven't been paying attention as much to what's happening in the auto zone. But Carvana and a lot of these companies that have gotten into the used car market, it had a great idea, I guess. But Wall Street is saying, Carvana was trading almost at $400, $376 at its high. It's down at $5 a share, right? Wall Street's pulling the plug. Carvana could never get their grand idea going. And now all of a sudden, used car prices drop. They were like saying, well, used car prices are up. They're going to stay up. Nothing is forever. And if you build a whole long-term business plan on something that's fleeting, so will your company be. I don't think Carvana is going to last very much longer. Yeah.
Well, I think the moral of the story here is that a lot of these names are just like in the media and in the news. And for I know from when we've started the show that you like the boring names, and there's nothing wrong with the boring names because there's consistency and there's strategies. And when you start to build out a portfolio and have a solid approach, then you start your own company and you teach people how to do it because it's working so well. And
that's right. I mean, look at that. I just got to show you on Carvana. I don't know what they're thinking, but ever since the beginning of time, all they've done is lost money. And just recently, they've lost big money, $2.89 a share, $2.35 a share. The companies that cash flow positive, especially when things get tight, it's companies that can make money, right? And it just seems like a no-brainer, but there are so many companies out there that for some reason, especially when times are good and money is flowing, they're like, we don't need to make money. We just have to keep the hype up. Well, as soon as things get tight, the hype goes away. And if you ain't making money, you're out of here. Investors don't want to know your name.
Yes, Steven just dropped another name, Zoom. That's a good one. It seems to be the trend with some of these names that had a lot of utility during the COVID times, and now everyone's kind of like, out of that mind frame and things are back to normal. But they definitely had that similar spike. All right, cool. Let's go ahead and keep the show moving. We're going to go into AJ's pick of the week here, but we did have a question come in that I thought was relevant. This one's from Pete, and Pete wants to know, how are some of your positions doing with this last downturn that we had?
All of my positions are doing fine. Some of the positions are getting, if they are covered put positions, they're in a position where they're getting exercised at max profit. I'm okay with that. So I've got a bunch of cash coming my way today, because what's today? Options expiration day for December. So we've got anything that was a covered put, looks like I'm going to get my max profit out of. I'm going to have some cash. So I'm going to be thinking about in the next week or two how to roll that cash into new positions. And they'll probably be covered put positions for sure. Any of the covered calls, they're getting the protective options are kicking in. So the protective puts are kicking in. And there are some cases where I've gone ahead and rolled out of the initial position, meaning I've gone ahead and bought back that sold option for almost nothing. It's worth nothing now. So I've gone ahead and bought that back, gotten out of my obligations, and I've gone ahead and been stopped out of the initial position at whatever that level was. And so now I've just got a put, and we know what happens to puts when the market goes down. These puts go through the roof. And so I've got a whole bunch of leveraged puts that are working for me. So that's one of the great things about our strategies, right? Our strategies self-adjust. So if they're a boring stock and they continue to go sideways, well, then we just make our income every month that we sell our premium and we roll out our protective options. But if something happens that causes our stocks or the market overall to go down or up outside of that sideways boring channel, well, then the positions adjust automatically. I just have to watch them do what they do. So it's pretty nice. My portfolio is absolutely fine.
Yeah, and Pete, I think, whenever there's significant market moves, everyone's portfolio adjusts a little bit, but the moral of the story is AJ approaches it knowing what the risks are, whether to the upside, to the down. There's always a max and min, and
Right.
You're just kind of leveling that out, with the different strategies. So
you are preaching to the choir, Sip. That's exactly right. I was actually telling the folks last night. So every Thursday we have a workshop with our program of premium sellers. And I was actually telling people, we were talking about how in the planning process, and I was comparing it because a lot of people approach the markets like it's something that they don't understand. They're like, oh, there's too much math involved. It's so different than the way I live my life. It actually isn't, right? Because think about the best parties you've ever been to. And what are the best parties you've been to? It's where somebody has taken the time and planned them out in advance. And not only have they planned out what could go right at the party, they have a whole kit of things to do so that if they see something going wrong, they have like contingency plans. They know what to do if it's an outdoor party and it starts to rain. They have all these plans about what might go wrong. And the parties are always the fun at the end. The parties that always suck are the ones that were just thrown together that nobody planned. Well, guess what? Trading is just like that too. If you think it through in advance and you plan out all the stuff that could go wrong, and you come up with contingency plans before you even put $1 down on the table, guess what? You're prepared. And when those things happen, a lot of your contingency plans could actually be automated and can go into effect without you even having to be there. And that's what we do here at Trading Trainer. We create a great trading plan, and then we trade that plan.
Yeah, and I just threw the link to, you should be able to find the link to the webinar where AJ goes through this in the chat. In addition to that, I know we've had just the last couple of availabilities for your one-on-one coaching, and we want to just throw this out in the show to anybody watching. In addition to the webinar, AJ has a wonderful program where he'll help, him and his team will help you build out a trading plan in a one-on-one capacity where you'll work with a coach. You'll do some calls together. You'll specifically go into your accounts and see what you can do, what risk parameters you have. And we've been getting a lot of good feedback from that. So if that's something that you're interested in, head on over to the link and schedule an appointment, and you'll get all your questions answered. How long it is, when you got to show up, what you got to do, if there's homework, etc. It's all there. And I think there's just a few seats left through the end of the year. Is that right?
We actually filled it up last night. So
Oh.
there's no seats right now, but Justin's coming on board, I hope, pretty soon. And so we should have a few more spots available probably the week after the holidays. So we're taking, these calls now. We actually have 3 more people who are interested in jumping in with us. And see, here's the key, Sip. People don't realize that I guarantee that whatever they spend on us to step them through, because we're actually going to not only teach them this stuff and handhold them in a one-on-one process, but we're actually going to trade with them for a minimum of 6 months. And I personally guarantee, but in writing, we also guarantee that if you haven't made that money back, the money you spend on learning from us while you're with us, we'll continue to work with you until you do. And I don't really want, you can see how busy we are. So we don't want to have to deliver on that guarantee. So we make sure you make your money back. So it's basically free, right? Because I guarantee whatever you spend on the program where you're working one-on-one with us, that while you're working one-on-one with us, we're going to be making the money. I call it learn while you earn. So a lot of people dig that. And so once they understand that we're going to stick with them and we're going to, trade their portfolio, they're kind of cool with it. And so we've been getting a lot of takers. Yep.
Yeah. And, I had a conversation with a friend the other day where some of his friends have come up onto some money, rather they sold their business or they had some luck and they don't know what to do with it. And I think your strategy and what we discuss on the show every week is, if you have a portfolio and you don't know what to do, this is a great way to safely put your dollars to work in the market in a way that makes sense. In using the one-on-one, you can actually work with somebody that's going to guide you through the whole process. So head on over to that link and schedule an appointment for after the holidays. I believe the calendar will allow you to do that. So, hey, just put it on the calendar and, get some more details. So let's go ahead and get into the meat and potatoes of the show, the favorite segment for everybody. And this is the AJ's pick of the week. This one is a name that I'm not familiar with. CEMEX, ticker symbol CX.
That's because the company is freaking boring. This is the largest producer of cement. I can't think of a product more boring than cement. But guess what? They make money, and they've been in business since hammer was a hatchet. And investors like to put their money into CEMEX because people need cement. People are building stuff, right? So let's take a look at this chart. I mean, if you go back in time, I'm going to go back. Let's go back 4 years. You can see that there's been some building sprees, but then we just now got into this nice sideways channels. There's times where different places will build out big, and so you see a spike in CEMEX, and then it comes back down. But right now, we're kind of in a little bit of a lull, and that's perfect for us premium sellers. And look, it's affordable. That's the other thing I like about it. It's trading at $4 a share. It's just bigger than a penny stock, which is great for us, but it's sticking around there, and it's very nicely finding support at 450, finding resistance at about 330, 335. And if we take a look at the option chain has enough liquidity. There's a little bit of a larger bid-ask spread given the price, but you could navigate this well. And you're only doing, when you sell premium, you're only doing a couple of transactions a month anyway. And so I wanted to feature this one because CEMEX just found itself atop, and it's on its way back down. It's still above the center zone. There's still time to do some paper trading or even real money trading on CEMEX. And I wanted to bring this one to people's attention because, again, it's all about these companies that aren't in the headlines, that have been around forever, that cash flow positive, that are sideways channeling, that we can pull an income off of, and we should.
Yeah, I mean, I think this opportunity hits a lot of the points that we like, and when we discuss on the show, low price, great industry. Is it going to be susceptible to a lot of the fluctuations? And when you think about cement, I mean, it's like a core product that the U.S. economy uses a lot of, and so definitely love the
The
covered call
world.
play here. Yeah, without
Yeah.
a doubt. All
The
right, so
world, yeah. This
we'll
is
keep.
CEMEX is one that people should keep their eye on. And like you said, like I said, at the $4 price, you could have a portfolio that's only couple $1,000 or even less. I bet you could trade this with even an $800 portfolio and get into the game. So think about CEMEX. Keep it on your watch list, if not on your hot list.
We'll definitely keep that on the watch list. All right, moving on to the speed round. And we actually have a couple of inquiries from the live chat. So we're going to go ahead and try and mix it all in. But let's start out with some new names before we go over some of the names that we've kind of been discussing. And this is Luke from Missoula, Montana. He's interested in Array Technologies, ticker symbol ARRY.
So we know that solar and batteries is hot, right? People are wanting to, whether it's about making an economic gain, whether it's about doing our part to go climate change, whatever it is, renewable energies are in the news, blah, blah, blah. That's hot. But what needs to build, what do the solar panels, get installed on? Array Technologies makes the steel brackets that hold the panels. They make the motors for panels that are on the ground that follow the sun. They make that. They make the nuts and bolts of the stuff that the solar panels live on. And there's not much competition in that market. There's a lot of competition in the solar panel market because that's where all the headlines are. But what about the steel frames that hold it? That's Array Technologies. And I like this. Again, cash flowing positive company. Let's go back in time a little bit. Let's take a look at 2 years. Yeah. So we've been hovering around this 15, going all the way up to 25, going down all the way down to probably $7.50. But for the most part, we've been going sideways for years now, and that's fine. That's exactly what we look for, these boring stocks. And it looks like right now we're in a kind of mid-duration channel that's testing about $15 up to about, I'd say, actually $22. And we're at a high here. I haven't gotten a signal using my fast MACD. Maybe a different signaling methodology might give us a signal. But I would, if I was going to be doing this, is I would make sure I've got an up-to-date trade plan on Array Technologies. Again, figure out where your bailouts would be. What would the underlying symbol have to hit to the top side and to the bottom side where you'd say this is no longer a sideways channeling symbol. Figure out your bailouts. Use some recent options in order to calculate what would be the worst case scenario, what would be these bad situations that would happen, and plan for it, right? It'll help you decide how many shares to buy or sell. It's at a nice price. And let's take a look, make sure that there's some options on this thing. There absolutely are, right? If we were to get into a trade in the not too distant future, in the next week or two, there's some January options trading every $2.50. And $2.50 is fine in this case. 25. If I bring out my magic marker, that means our option strategies could be placed here, here, here. There's enough granularity with the $2.50 price strikes that we can create all sorts of really nice setups that would build a lot of, pre-built confidence. So get your planning in place, and then let's wait for that signal, however you're looking for it, that a top has been found, and either paper trade if you're just learning this stuff, or real money trade by either shorting Array Technologies and being prepared to do a covered put, or buying some back month, deep in the money, far out in time put options that would allow us to also sell some put premium when the time is right. Either one of those strategies, whether it be the covered put or the bear put diagonal debit spread, those would be perfect fits here, and I love it.
Yeah, I wonder if seasonality has any play, right? Given that like we're in the dead of winter, maybe there's some pullback until spring or summer.
I
I'm not
think these
sure.
people ship around the world. It's always summer someplace in the world. Australia
Okay.
is summertime right down. Remember, Australia has mandates from the government that they have to do so much renewable. So Australia is like big into the solar play. So
All right. Well, thank you, Luke from Missoula, Montana. Moving on to a name I think we covered last week. This is Mike from Plano, Texas. He wants to know, hey AJ, what's going on with American Airlines?
this was actually one we did on Tuesday.
Or 4 days
Uh,
ago.
yeah,
Yeah,
yeah.
2 days ago. Something
So
like that.
what I was saying about American Airlines, Mike, is we're right in the middle of the channel. A few days ago, I'm like, we're right in the middle of the channel. This is where you take your plan and you update it. You make sure everything is right. Well, guess what? Just in the last 3-4 days, American Airlines has moved back into the lower area of the channel. And so this is exactly where we want it to be, isn't it? Right down. Oh, let me make sure I've got the right drawing tool. Right down here is where we want it to be, but we don't want to pull the trigger on a covered call or on a bull call diagonal debit spread until it's gotten as far as it can. So we want to wait for a good bottoming signal. And again, I don't care how you find your signal at a bottom. Some people, like I like this fast MACD. I also like using some trending. Some people are fans of the stochastics or the RSI or the shaken. Some people like to use, candlestick bar patterns or price patterns. Other people use quantitative analysis like NASDAQ level 4. They look at buying and selling. Doesn't matter to me how you get your signal, but let's wait for a strong validated signal that a bottom has been found. But we're already in the right area of the zone. So we're getting ready to either buy some stock or buy some deep in the money, far out in time, back month calls. And that's going to support this American Airlines trade just fine.
All right. Wonderful. Got some live questions coming in. This is one that we've covered in the past. I believe they're pharmaceutical, Teva, Teva.
Oh, yeah. So Teva's back into its sideways channel. I'm a little bit worried about Teva, meaning that it is consolidating, meaning that instead of going sideways, it's kind of getting tighter and tighter. And what that tells me is that investors are getting a little bit on the nervous side, meaning they're waiting to see what happens. And again, it's human nature. The longer you keep people kind of waiting for what's going to happen next, anxiety rises within these investors. Anxiety rises within, it's human nature. And so, whereas like in the beginning of this, if a news headline came along, investors would just kind of be like, oh, that's in the everyday move left or right. Now that they've been waiting, any little like news headline will set it off like a tinderbox, and you're going to get maybe a break up or down. So if you're in a premium selling position, I'd be saying, hey, why don't we wind it down? Why don't we look for a way to take our profits out? This is starting to become, at least in my mind, a little bit on the unstable side. So whatever we can eke out, let's go ahead and do that now, kind of ahead of the game of something breaking out.
Awesome. That's Teva, Teva. The next speed round ticker, I believe this is what we've covered too, is MARA, Marathon Digital Holdings.
Yeah. So this is one that we talked about right before it started to go down. So depending on which position you're in, if you're in a covered put or a bear put diagonal debit spread, then you're going to get exercised and you're going to get your max profit and cashed out here. You might be in a protective call. That protective call we talk about being more than 3 months, somewhere between 3 and 6 months out. So we're going to wait for Marathon Holdings
Digital
to rebound a little bit before we get rid of that protective call. But we're probably going to get exercised. and we're going to get exercised at the position. This is one of those self-adjusting positions. If you're in the covered put, well, this is a case where we got plenty of exit signals that said get out of the initial covering position and let your protective put go. So, I mean, we're letting our put go now. If you're in a protective put, just let it go until it bottoms, and that thing's going to keep going higher and higher, and cut your losses on the initial covering position. You should have done that if you followed your plan weeks ago.
Awesome. Marathon Digital Holdings, and our final name of the day in the metal space. I believe this is the silver ETF, SLV.
So again, it's out of its sideways channel, right? And so in this case, if you're in a covered call, it's going to get exercised. You're going to hold on to that protective put until it falls back down as far as it's going to go. And that's when you liquidate the protective put. You don't liquidate the protective put when it's at its lowest. You wait till it regains. That's why we go 3 to 6 months out. It gives us that buffer of time. If you're in the covered put, well, then same thing. You should have been exited out of the initial covering position, and you're now in a protective call that should be making you lots of money on side. So it's all about, creating the trading plan and then following the trading plan. A lot of times I find people that don't actually follow through on the plan. They don't exit the initial covering position when the plan says to, and then they're stuck, right? They're in this place where they're like, I let it go underwater. Well, why? The plan told you to get out of the position if it was to get bailed out. Even better if you get a technical signal. So make sure you follow the plan. We spend all this time learning how to create the plan. Now it just takes discipline to follow the plan.
Yeah, and when you're spreading around your ideas, you're going to get a few winners, you'll get a couple losers, but it's nothing that gets out of hand. That's really what I think a lot of new traders are so eager to make money so fast that they allow the risks to be a little bit heightened because of the reward is there, but over time, you just need those 3-4% winners, 3-4% winners month after month after month, and then you'll get an 18% winner, you'll get a 35% winner, you'll get a 5% loser, right? Like it's something you can maintain, and you take the emotion out of it.
Overall, guys, you want to try to target a 6% portfolio growth. Now, again, like Sip said, you might have some winners that are at 15, 20%. You might have a loser. You'd have, one thing I was telling my folks last night is we plan in the worst case scenario where everything goes wrong. And then our plan says, if one of these things go wrong, go ahead and close the position. So if everything goes wrong, then we expect a certain amount of loss, like 2%, 3%, 4%, and then we're done. But if one of those things go wrong, maybe a 0.5% loss. So I tell my folks that if you have trades that go where everything goes wrong, and you have 3 of those trades in a row, stop what you're doing. Cash out of your portfolio. You have to go back to paper trading because it's not the markets throwing you curveballs. It's you not following your plan. It's something wrong with you and your trade planning, and you're following your trade plan. So you need to go back to the drawing board and become a more proficient trader. It's like being an athlete, right? I'm pulling you from the game. If you get a hat trick in the wrong direction, I'm pulling you from the game. Go to the sidelines. You need to go back to practice, and you need to double your practices during the week until you get good enough. Your skills are back for you to get back in the game. But you should not be hitting those things. We put those max worst case scenarios, but that should not be where we get stopped out. We should only get stopped out when one of those things goes wrong. It should be very rare, like once every couple of years, that you hit a max loss situation. It tells me that you're not following your plan, or you're not doing a good planning for all your contingencies.
Yeah, so practice in the demo, get the education. We've got links in the chat. Hey, AJ, next week is Christmas, right? Next week is Christmas.
Yeah.
What should we be looking forward to? How is the rest of the month, the rest of the year shaping up? What advice would you give to anybody?
So the week
Investing.
after, the week after Christmas is an interesting week, right? It's every year it goes kind of crazy. And I want you guys to pay attention to volume, because this is what happens. And again, think about it. In everyday life, what happens between, say, the December 25 and January 1? People hang out, they watch Netflix, they sit in front of the fireplace, maybe they do some skiing or something, and they have a lot of family time, right? That's the normal, and I hate to use that word, but I did, normal thing to do. And a lot of the market movers and a lot of investors, that's what they do. They take a break. And so what does that mean? If there's people still in the market trading, it's usually those people that have kind of extreme thoughts about, things. I mean, why would they be there trading when the rest of us are taking a break, right? So they're in there trading and they have some extreme views about what's happening in the world. And so they tend to take the market in some weird places on those 7 days, that 1 week between those two holidays. And I don't want anybody to be duped. Make sure you use your volume validation when you're looking at these trade signals, because I call it a few extreme traders taking the market wildly, right? A few investors speaking loudly. They move the market all over the place. And then January 2nd, January 3rd, when the masses come back and they're back in their trading and the big money people come back and they're moving money, everything recalibrates and it's back to normal again. So don't be duped by funny signals like something crazy is happening between December 25 and January 1. It's usually those extreme voices speaking loudly.
So it's put your position on, go hang out with the family, watch some Netflix, wait till everybody comes back from vacation, and we'll start to get some movement again.
Back test. Do some back testing, right? Go prepare. Yeah, take the time to plan and prepare and have some family time, have some hot cocoa. Unless you're in Arizona.
Yeah. All right, AJ, thank you for your time. Thank you, everybody, for tuning in. It's good that you're feeling better. Got your voice back. We had a little hiccup there last week, but hopefully everything is back on schedule. We've got some good names out there for people to look into. We've got the links out there for anybody who wants to check out the webinar, learn more about one-on-one trading. We've got the mastermind every Thursday. You can send us a DM, email us, and we can give you some more info about that. If you've appreciated the broadcast, hit that like, hit that follow, hit that subscribe button. Tell your brother, tell your sister, tell your mom, tell your auntie, tell your neighbors. And with that, AJ, any final words?
Nah, just have a great holiday, everyone.
All right, everyone. We appreciate your time, and we will see you guys next week. Adios.
Bye, everybody.
Thank you for tuning into the AJ Brown Show. If you're interested in learning more about AJ and his investing techniques, head on over to tradingtrainer.com and create your free account today. And if you're not already a subscriber to the show, hit that subscribe button and we'll get you fresh content daily.